Hello everyone and welcome. My name is Dan Sampaio and it's my pleasure to open today's Mondac webinar in association with Mourants, focusing on recent global private capital developments from a Channel Islands perspective. Just to let you know, we are experiencing a few technical difficulties with our panel, but we have nearly everybody with us now. So they will be able to present to you fully the webinar today. And before I hand you over to the panel, just a housekeeping item. You're able to submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page. We'll endeavour to answer as many as possible during our Q&A at the end of today's session. It's now my pleasure to hand you over to Ben to begin. Thank you.
Thanks very much, Dan. I'm Ben Robbins. I'm a partner in the Jersey funds team at Mourants. And yeah, we're going to adopt a bit of a sort of microscopic lens today. So start with a sort of macro global picture and then zero into the more sort of detailed local picture, if that's okay. To start with, Darren Bacon, a funds partner in our Guernsey office, and I are going to look at some of the disruptive effects of current market conditions and how the world of private capital is reacting. We'll then hand over to Francis Watson, another funds partner in our Guernsey team, and Joel Hernandez, who heads our Jersey funds team. And they're going to zero in on fund structuring trends that we're seeing across our Channel Islands offices. And then Francis and Joel will hand over to Mike Jones, Managing Director of our Mourants Regulatory Consulting business, and Sally Rochester, a director in our Mourants Consulting team, to talk about regulatory developments in the Channel Islands. As we've got a fair amount to cover off, conscious we're pushed against time a little with some of the technical difficulties, so do send those questions in. We'll try and get to some if we can, but if for any reason we can't get to them by the end, we'll follow up with you individually afterwards. So to kick off, first slide please, Aaron. What do we mean by private capital, a term that a lot of people are using now? Well, we're adopting it as a broad term for private investments in private equity, venture capital, private debt, real estate, infrastructure, and natural resource asset classes, and others that sort of flow from that. Thanks, Aaron. And what are we seeing right now? Well, I think you describe it as that after a period of uncertainty, we're entering a period of uncertainty after a sustained period of growth. We've had record-breaking fundraising and deal activity across many private capital asset classes in 2020 and 2021, notwithstanding the pandemic, perhaps to some of our surprise, and seeing sharp growth now in private financial markets as low interest rates have driven investors towards illiquid private markets offering higher yields. But as we entered this year, the era of rising valuations and cheap debt is over, according to a recent Economist article. So what does this mean for private capital? Thanks, Aaron. Well, there's a new backdrop: high inflation, skidding stock markets, today being no exception, public market sell-off, tightening monetary policy with sharply rising interest rates, supply chain disruption, still some pandemic tail effects in certain sectors, and of course the war in Ukraine creating energy security issues. Now, since 1956, in periods of rising prices or central bank rate increases, they've tended to limit demand, which then brings the inflation rate back down, and hopefully then a fresh post-recessionary growth cycle begins. Now, those inflation recession cycles generally tend to be quite short-lived, so dare we hope that the same we can experience the same short recovery beyond 2022. And how will private capital react in the meantime? Thanks, Aaron. Well, what we've certainly seen so far in 2022 is that fundraising has slowed in the first half, most notably in buyout funds. This was spotted by Bain & Co. in their excellent mid-year private equity report this year. And certainly we, have seen, and talking to our clients and intermediaries, detecting investor fatigue after such a sustained period of capital deployment and investment over the last 2 years. And a few reasons for that. Investors are facing allocation restrictions. I mean, some of them have already used up their 2022 budgets. There's the impact of what's called the denominator effect. So with public equity values down, but private valuations holding up, the amount that some investors can deploy towards their private capital allocation as an overall percentage of their portfolio value is diminishing. They've simply got less to allocate towards private capital investment. And so they're facing difficult decisions in terms of who makes the list. And they're analysing previous fund performance and having to make difficult decisions in a way that perhaps they weren't in recent years. So as a result, what we're starting to see is launch dates for this year pushing back into next year, allowing GPs and managers hopefully to access next year's investor allocations instead. Thanks, Aaron. What's bucking that trend is mega funds, those raising about 5 billion or more, definitely impacted less because those larger GPs and managers generally regarded as a safer, trusted bet during periods of uncertainty. And of course, once an established investor in a chain of mega funds leaves the list for a fund, they might not be able to get back in for the next fund, and you miss out on your investment opportunity in the next fund. What smart investors are generally doing is running downturn scenarios across all of their portfolios and then making critical adjustments to their due diligence approach. In a falling market, there's just less scope for speculative investment. So investors, frankly, are simply being more cautious. And against that backdrop, it's just proving harder, and I think for a little while will prove harder for small, new, mid-sized GPs and managers, unless they've got a really compelling niche area for investment or a really compelling track record. Thanks, Aaron. As well as fundraising activity falling back, the same is probably true of deal activity. In the first half of the year, actually, private equity deal value was relatively strong, but I think those inflationary pressures are now being felt. So we've seen a slowdown in private markets and deal activity as we enter into the second half of the year after the end of that very buoyant business cycle. And the uncertainty around inflation and asset valuations has slowed deal pipelines. There's valuation uncertainty due to falling revenue projections and increased wage costs within underlying businesses. So buyers are looking to reappraise target prices. And of course, vendors who've seen nothing but sort of strong asset valuations in recent years are understandably reluctant to give up on those strong valuations when it comes to exits. And of course, it's becoming harder and more costly to obtain portfolio company debt. Banks are asking a lot more questions about underlying businesses' exposure to inflation and rising rates, and they're being more demanding on their terms and their covenants. That's making it harder to close transactions, but arguably it may well open up new space for private credit funds. I mean, credit fund activity is certainly one of the more buoyant asset classes in recent years. Query whether that'll create space for them to occupy in providing finance. All of these factors likely to weigh on near-term fund performance. Thanks, Aaron. So how are GPs and managers reacting to these market pressures? Well, of course, a recession does become entrenched. The internal rate of return on funds and some fund investments, particularly those made prior to the downturn, will likely fall. So to counter that and to bolster their IRR, the smarter managers, they're going to anticipate these changes, get ahead of them, manage their portfolios proactively, good old-fashioned asset management, and run inflation and recession scenarios against each of their portfolio companies and find support where they possibly can. Of course, historically, important to remember, the internal rate of return from investments made during recovery years has consistently outperformed the long-term averages. So one positive spin to put on this is that it's all to play for now. You know, lower valuations now may well lead to higher IRR returns in the years to come. I'm going to hand over to Darren now to continue our macro analysis. Thanks, Darren.
Thanks very much, Ben. So what are we seeing in terms of the market impact on private capital liquidity? Well, as Ben's alluded to, public market falls in 2022 are impacting exits. There's no doubt. The London market in particular and the IPO market more generally has all but dried up. This lack of attractive exit options and uncertain valuations for existing fund assets has seen exit events decline significantly, so less sale deal side activity. As a result, we expect a continued rise of the secondaries market as both investors and GPs look for alternative ways to generate liquidity. So we're going to go on and talk about LP and GP-led secondaries, if we could see the next slide. So what do we mean by LP-led secondaries? Well, that's where an investor sells their own stakes in PE funds to manage their own allocations and crystallize gains. For some LPs, fund distributions are a key source of capital to meet any of their unfunded commitments. So secondaries can obviously generate liquidity funding for them. Query, however, whether some LPs will look to trade interest in their pre-downturn funds for interest in new funds to capitalize on the long-term IRR recovery. Also, potentially fruitful conditions for secondaries funds who invest in LP interest. I mean, certainly we've seen Ardian, Harbourvest, Goldman's and others particularly active in this space. Next fund, please. Next slide, please. So if we look at GP-led secondaries, these are transactions initiated by GPs, which can vary from simply facilitating trading of LP interest in an existing fund to rolling one or more fund assets into a continuation vehicle in which current LPs may or may not choose to invest alongside new investors. Also, secondaries allow GPs to monetize stakes in portfolio companies where they don't wish to exit completely, or to delay the exit of portfolio companies to maximize potential growth depending on market conditions. We've certainly seen a number of these transactions recently, and indeed fund extensions as well. Finally, GP-led deals have clearly surged in the US market and become almost the norm. And we certainly see many GPs in the US market engaged in these types of transactions. Next slide, please. NAV facilities, so net asset value based facilities, are clearly increasing in the market. And what we're seeing is basically an increase used by funds for a variety of different scenarios, either to access additional capital to grow assets, to provide immediate liquidity to investors via accelerated distributions, or to manage underlying portfolio company indebtedness, or a combination of all of the above. Now, NAV facilities limit the lender recourse to the assets of the fund, as distinct from subline facilities, which would allow recourse to LP commitments. So often it's cheaper to use these financing alternatives to other sources of capital, and they're also available for longer. They can be available much longer than traditional liquidity and subline financings. And so we've seen an increase in NAV facilities. Obviously, what we haven't seen yet is the effect of increased interest rates on the availability in the market of such NAV facilities. So watch this space, I think, in terms of NAV facilities. Next slide, please. In terms of investor trends, what are we seeing? Well, certainly LPs are exerting ever more influence in relation to ESG requirements. That's either seeking to understand the manager or the GP's investment strategy, or to ensure that the reporting of ESG requirements matches their own investor-led requirements. Appetite for co-investment continues apace, and we've seen many Channel Island structures in Jersey and Guernsey providing co-invest opportunities for investors. More broadly, there's a move towards the democratization of alternatives, and particularly in private equity. I mean, private equity really has become mainstream, and if you look at the Goldman Sachs briefing of June of this year, they're talking about up to 20 to 30% of their next round of funds coming from individual investors, either via endowments, pension funds, or wherever. We've also seen a huge uptick in family office investment, and this is reinforced by the Preqin statistics again from earlier this year, saying that 56% of family offices intend to make direct investments in PE in the future. That compares to 51% in VC or 63% in real estate, respectively. Next slide, please. Where is investor interest settling? As you might expect, investors are focused on portfolio diversification and aligning their investment strategies to long-term economic and demographic shifts. In private capital generally, we're seeing a focus on sustainable investment opportunities, infrastructure, food security, remapping of supply chains, renewable energy, energy transition, medical and healthcare. In relation to real estate specifically, we're seeing logistics, life science, rented housing, student accommodation, hospitality, healthcare assets. All of those were identified by Blackstone's first quarter 2022 report. All of the above are in high demand and generally tapping into pandemic recovery cycle and broader societal changes, providing opportunity for increased revenue growth. Thank you. Next slide. So what does the future hold? Well, in the short to medium term, fundraising, we believe, will remain challenging, particularly for smaller managers without a differentiated niche, and deal activity will slow. However, as Ben mentioned, we've seen the rise of the mega funds, so the established players continuing to raise very large funds, but for smaller managers, more difficult. We think liquidity will be bolstered by more secondary transactions, as we've said, continuation vehicles, NAV facilities, etc. Over the long term, the rapid growth of private capital markets since the turn of the century will likely continue. Private capital investment has become an essential part of investors' portfolios, offering access to market-leading investments that generate consistent returns throughout the economic cycle. Returns from investments made during recovery years, as Ben mentioned, after the recession have consistently outperformed long-term averages. So investors will want to catch that recovery upswing if at all possible. Turning to Bain's mid-year private equity report again, as they concluded, the long-term outlook for private equity remains as strong as ever. LPs have consistently signalled their intent to maintain or increase PE allocations. They remain confident in the fact that PE returns outpace other asset classes. And with $3.6 trillion in dry powder generating fees, GPs are well positioned to ride out a downturn and prepare for the recovery. So broadly, for patient capital, this could be a real opportunity, but watch this space, particularly in relation to interest rates. Thank you. Over to Joel and Fran.
Thanks very much, Darren. So if we could turn to the first slide, please. So what Joel and I wanted to do in this session was to drill down a little bit more into private capital as we're seeing it in practice within the Channel Islands. And we're going to focus on 4 areas: a market update for Jersey and Guernsey, the current funds regimes available in Jersey and Guernsey for private capital funds. We'll then look at some case studies. And finally, we're going to look at some recent and anticipated legal developments in the private capital space. So, Joel, over to you to lead with Jersey market developments.
Thank you, Fran. Hopefully you'll be able to hear me. I've had to dial in twice. I was the one struggling with technical issues. Hello, everyone. I'm Joel Hernandez. I head up the Jersey funds team at Mourants. So as Fran suggested, we're going to be looking at the Channel Islands specifically. And where I wanted to focus on first was where Jersey and Fran will be looking at Guernsey specifically, where Jersey fits into the picture. So in terms of Jersey market developments, I'm conscious many of you in the audience might actually be considering the Channel Islands, but this is where Jersey is at. In terms of assets under administration, assets under management, Jersey has been on a steady incline over the last few years. I mean, we talked about a few of the mega fund launches. They're certainly prevalent in Jersey, but as it stands at the moment, we've got 459 billion under assets under administration or under management. Alternatives is where Jersey's space is at. Now that's approximately 90% of Jersey's fund business at the moment, focusing on alternatives, with PE and VC making up about 44% of that. So a very healthy portion of PE and VC space, with the balance made up of hedge fund business and also real estate, with Jersey predominantly being a main investment hub for UK real estate. The third bullet point on the screen there is talking about the global mega fund launches, and we have seen those. So Jersey's, that 459 billion figure, actually helped by very large household PE names launching funds, domiciling their structures in Jersey. SoftBank, CVC, Nordic, Triton, Ardian being amongst some of those very large funds still continuing to use Jersey. But what I would say is where Jersey really offers it, or where its core fund offering is it's really there for the rest of the world investors. So fund managers choosing to use Jersey to access rest of the world investors such as UK, US, Middle East, Asia, to the exclusion in some cases of the EU. But we can't actually discount the EU completely. Jersey still offers an access point to the EU, even though despite it's not being in the EU, we've got about 342 funds being marketed in EU in EU states that actually have workable NPPRs. They tend to be Northern Europe and the Scandinavian jurisdictions. Aaron, next slide, please. Okay, just a few more highlights here from a Jersey perspective. I do have to mention the Jersey private fund regime. Now, for those that are unfamiliar with Jersey, Jersey launched a private fund regime a few years ago. It's been a resounding success. There have been over 500 funds launched under this regime, and it really is one of the success stories. We've had about 100 of these launched in the last 12 months. And in the next few slides, I'll be speaking a little bit more detail about that private fund regime. But I would say with the advent of private funds coming into the fore, I would say that Jersey's more highly regulated fund market has actually plateaued somewhat, with more managers pivoting towards launching Jersey private funds instead. It would be remiss of me on the third bullet point here not to mention jurisdictional competition. That is actually still remains intense, with Jersey competing amongst other international finance centers and also competing with some of the onshore jurisdictions. But with obviously with that jurisdictional competition in mind, actually, that has driven a lot of innovation, and Fran and I will be talking about some of the more innovative leaps that Jersey has made. In addition to the Jersey private funds regime, there are others coming down the track or in place at the moment that's looking to attract more fund business to Jersey. And last, before I hand over back to Fran to talk about Guernsey, I would say that there's co-investment and fund finance activity certainly increasing. But in the next few slides, what we will show you is Jersey does offer a clear position for funds and non-funds, and that distinction will come through when Fran and I look at more of the individual case studies and the regimes. Fran, if I may, just hand back through to you.
Thanks very much, Joel. So overall, the themes and trends which Joel has described very much apply to Guernsey. Net asset value of Guernsey funds, according to the statistics published by the Guernsey Financial Services Commission, they currently stand at approximately 302 billion, which is an increase of about 11% over the last year. And a large proportion of this is in regulated private equity funds, with managers over here including Equitex, Cinven, Harbourvest, HG and Inflection. We're also seeing a significant growth in carry, co-invest and managed account structures. These sit outside of our published statistics, which focus on regulated funds, so we can't easily put a figure on this. As with Jersey, Guernsey's core alternative funds offering focuses on structures with rest of the world investors, US, UK, Middle East, Far East and Switzerland, and marketing into the EU is permitted through NPPR. Next slide, please. And as with Jersey, Guernsey has been whitelisted following the introduction of economic substance legislation. It's received approval from the EIB to invest with Guernsey-based managers, and concerns around CGT for UK real estate through Guernsey and Jersey funds has been allayed. And then finally, Guernsey also is known for its expertise in listing vehicles on capital markets. We currently have more than 100 Guernsey companies listed on the LSE. Guernsey also has a long-standing expertise in private wealth, which is a growth area. Our funds team is seeing increasing instructions here, both in terms of family offices investing into Guernsey domiciled funds, but also forming Guernsey domiciled funds to collectively invest family wealth. Next slide, please, Aaron. Thank you. So what attracts these clients to the Channel Islands? I think these are some of the key areas which we felt we could identify. These are ones which we hear from clients and intermediaries about what attracts and retains managers to the Channel Islands. And I think first and foremost, we have to point to the fact we have a long history and expertise in financial services. It means that the regulator in each island has a deep understanding of the industry, making it predictable, approachable and proportionate. Our tax regime is simple, tax neutrality, no VAT, no CGT, and no reliance on a complex system of rulings or DTAs. There's an overall level of service quality and global familiarity. Again, I would say this is largely driven by our decades of experience in the private fund space. We have streamlined regulatory procedures, which means we offer a speed to market and cost effectiveness. There's political stability and predictable legal systems. There's crown dependencies. We're autonomous as to domestic matters, which means we can introduce finance industry focused legislation quickly. And finally, the EU-centric reasons. With respect to the EU, we are and continue to be third countries for AFMD purposes. And this has made us particularly attractive for managers with rest of the world investors who don't need full AFMD compliance. And we have tried and tested solutions for navigating marketing into the EU on national private placement basis. Having said that, we're also passport ready with our laws when passporting is made available to 3 countries. And I think it's fair to say that overall our approach has very much been one of business as usual with no change to our offerings as a result of Brexit. So we're going now to have a look at the Jersey and then the Guernsey funds regime. So again, I'll pass back to Joel to lead on Jersey. Oh, I think you're on mute, Joel.
Hopefully you can hear me now, Fran. I've had to go to my backup. Excellent, thank you. Okay, so in terms of Jersey funds regimes, one thing that both Jersey and Guernsey have in common is a smorgasbord of fund regimes. And the reason for that is not every fund manager comes in the same shape or size. In terms of Jersey, it's relatively simple. There are three buckets, relatively simple menu of funds. On the left-hand side, I've mentioned Jersey private fund regime, and that is accessible for private funds looking to raise up to 50 investors. And I've highlighted this section in yellow, only because this is where we are seeing the most activity. In terms of what it means, the Jersey Private Fund Guide, which is issued by the Jersey regulator, actually sets out the various requirements. But suffice it to say that it is a lighter touch regime. It does allow for EEA marketing to be provided under the NPPR regimes. And also the good news is that for those setting up Jersey managers or Jersey-based advisors, there are various exemptions available. So the key things to remember is up to 50 investors, and it's also a light touch regulatory regime. Moving on to the right, the two columns on the right-hand side, we've got our more traditional public or regulated fund regimes. Now, these have the benefit, and Fran and I will be looking at a few case studies. We've got 8 to look at, but these offer unlimited number of investors. But as a trade-off, they are slightly more regulated than the private fund regime. We are still seeing quite a number of funds being launched. The mega funds that we've spoken about, which tend to have hundreds of investors raising billions, tend to fall in this middle category, whereas our smaller fund managers, first-time managers, preferring the left-hand side. Now, on the right-hand side is the more public, but they are unregulated funds. Now, these are where there is no need for EEA marketing, but they tend to more mimic the Cayman version of the Cayman-style unregulated funds. There's several hundred of these in existence, but they tend to, if you like, they tend to be more specific in nature, tend to be more hedge-orientated. If I may, Fran, I'll just hand over through to the Guernsey funds regime. I'll let you speak through that.
That's great, thanks, Joel. So Guernsey offers a wide range of regulated fund structures depending on the manager and investor requirements. And what I've tried to do with this slide is to show all of the Guernsey fund regimes available, going from the lightest touch on the left-hand side to the most regulated on the right. And with private capital funds, unless there's a particular structuring reason for them need to be authorised, which is more on the right-hand side, we'd normally expect them to be either private investment funds or PIFs, and registered funds, because these offer a faster market regulatory timeframe and an overall lighter regulatory touch. And I've highlighted these as yellow on the slide. And in the case studies that Joel and I are going to move on to, we'll be able to see these in a bit more of a diagrammatic form. But very briefly, just picking up on each of the two regimes. So the private investment fund, or PIF, is used buyers where there's no intention for the fund to have more than 50 investors. There's no requirement for an offering document or PPM, but if the PIF has one, there are no specific disclosure requirements. The PIF rules were updated last year, so there are now 3 routes. The first route is where a Guernsey licensed manager must be appointed to manage the private investment fund. That would typically be the GP in a GP-LP structure. And as part of the application process, the general partner must provide a declaration on the ability of the investor to assume the loss incurred on their investment at the time the investment's made. Route 2 to the PIF is where all the investors are qualifying private investors, and that definition would include an individual investor investing $100,000 US, where the amount invested represents no more than 25% of their investable assets. And then finally, reflecting the private wealth trends that we're seeing, we have Route 3, where all of the investors share a family relationship or be eligible employees of the family. And the PIF rules here deliberately don't define a family relationship. It's intended to be flexibility. So this isn't, for example, limited by bloodline. Where there's more than 50 investors, a registered fund would be used. There's no restriction with registered fund on the number of investors, and this product has a 3 business day turnaround time with the regulator. Registered funds must have some form of offering document or PPM, and that would need to comply with straightforward minimum disclosure obligations. So looking at some of these examples in practice, I'll pass on to Joel to look at these case studies.
Excellent, thank you, Fran. So here we're going to be looking at 4 case studies in Jersey. And the first case study I've put up is a single asset vehicle, single investor, or a co-investment or JV vehicle. Now we've taken a traditional structure such as a Jersey GP here and a fund LP, although you can mix that up, make that into a corporate or the unit trust, the analysis remains the same. The reason I wanted to put case study 1 up is just to show the difference between what is considered a fund in Jersey and what's not considered a fund. So case study 1 versus case study 2. In this case, where we have this structure going into a single investment and we only have single or co-investments or JV partners, this is not considered a fund in Jersey. So if there's anyone in the audience looking at a structure like this won't be a fund. And the good news with that is, in terms of establishment or Jersey regulatory fund permissions, you can establish this on a same-day basis and you won't necessarily need any Jersey regulatory fund permissions at all. What we would expect, however, is that this type of structure, that the general investment side would be 250,000, or that the investors coming in would be professional investors. If I can contrast that, Aaron, next slide, please, with case study 2. The key difference here is on the left-hand side at the bottom, which is multiple investments and up to 50 investors. Now, this starts to look and feel, because of the risk spreading and the diversification of assets, starts to look and feel like a fund. And this type of structure would definitely fall into a traditional fund that will require Jersey regulatory permissions. Now, this is, in this particular case, up to 50 investors. A Jersey private, this would be ideal for a Jersey private fund and under the Jersey private fund regime. And the good news about this is that in terms of Jersey regulatory permissions, you will need a very simple private fund consent that can be issued normally within 72 hours. And these vehicles can also be established on a same-day basis. In terms of the investment size, it would be the same as the previous slide, which is generally 250,000 of professional investors. But this falls into the camp of the light touch regime that I was talking about, the Jersey private fund regime, of which there have been about 500 launched in the last few years. So this case study 2, a very popular option. If I may just contrast that with case study 3, Aaron, on the next slide. The difference here is a slightly more detailed slide, because what we've got here is the same structure, Jersey GP Co, Jersey Fund LP, investing in multiple investments, so that still remains the same, still no more than 50 investors. However, in this particular case, we do have the presence of EU investors. Now, this additional EEA marketing actually will mean that there are some additional regulatory permissions required in Jersey. So in addition to the very quick 72-hour private fund consent, there will be the need to obtain an AIF certificate. But importantly, because of the agreements between the Jersey regulator and also the EU regulators, there will be a need for the Jersey regulator to approve that EEA marketing and apply some regulation. That regulation or additional licensing, it's otherwise called an AIF services business license, is normally obtained within 10 working days. However, if this is a non-sub-threshold manager, normally we would warn clients that there will be some vetting of some relevant individuals, normally those that hold greater than 10% of the GP Co, to be subject to some vetting. So that normally takes 6 to 8 weeks. So just bear in mind, if there is EEA marketing, this JPF, this Jersey Private Fund, can be launched, can actually access EEA investors. However, bearing in mind that it will be a slightly longer process. Now, let's move on to case study 4. This is the fully fledged mega fund that I was talking about earlier. If we are launching one of these, this is an unlimited number of investors, and let's assume here that there will also be EEA investors coming into this. We've taken the same fund structure, and let's run that through the same analysis. Here, in this particular case, this is higher up in regulation, so there will be some SIF certificates. This is otherwise known as an expert fund in Jersey. And in the case of the Jersey General Partner, that will be a fully fledged fund services business, which means that it will need a license. So in this case, the actual expert fund permissions can actually be obtained within 72 hours. However, due to the EEA marketing in this particular case, then normally the EEA marketing permissions will arrive within 10 working days, but then there is that kind of pre-vetting of around 8 weeks in relation to the individuals that may perhaps hold interest in that GP. And so they're the individuals that hold greater than 10%. The slight difference between the case studies 1, 2, and 3 is in relation to the investors, which is set out here on our slide, which is the other notes. And the expert funds in Jersey tend to allow a slightly lower equivalent in terms of their investment size. So in the expert investors up to 100,000 US denominated can actually become investors in this particular fund, in contrast to the 250,000 sterling that we had in the previous funds. So those are the 4 case studies in Jersey that shows you the full plethora, if you like, from the single asset all the way through to the expert fund. I may now just hand over to Fran so she could do the equivalent in Guernsey.
Thanks, Joel. So the first 2 studies I wanted to look at were unregulated. These don't need to be regulated as funds in Guernsey. The first one is the single investor vehicle. Here we've got third-party management, 1 or more investors, but we've only got 1 investor. So this is not going to be a fund for Guernsey regulatory purposes. It can be established in 1 day, subject to obtaining CDD, and assuming it's not a GPLP structure where a standard exemption from licensing under the fiduciary law would be required, there'll be no regulatory application and there'll be no requirement for an audit. So the next study, please. Again, this is unregulated for Guernsey regulatory purposes. Here we have a single investment, third-party management and multiple investors, not a fund, established in 1 day subject to CDD, and again, assuming it's not a GPLP structure where we need our fiduciary exemption, there'll be no regulatory application, no requirement for audit. Next slide, please, Aaron, thank you. So this is what a simple Guernsey fund structure would look like, comprising third-party management, multiple investors and multiple investments. It will need to be regulated by the Guernsey Financial Services Commission as a collective investment scheme, and provided there are no more than 50 investors, it will be eligible to be registered as a private investment fund with a light touch regulatory regime, which I've already touched on. And then the final case study, here, where there are more than 50 investors, we would want to establish this as a registered collective investment scheme. This has a 3-day working application process with the GFSC and a further 10-day working days if there are any related licenses, such as a manager or a GP in an LP structure. So the final section, we're going to just take a quick look at current and future developments. So again, handing back over to Joel to lead on Jersey.
Thank you, Fran. So in terms of other developments, Jersey-wise, I mentioned earlier in the seminar talking about competition. And in terms of competition, that brings innovation. And in relation to Jersey, these are 2 that we've picked out that may be attractive to some of the people in the audience. Now, one of the things, the first one there is about the limited partnerships law. And one of the things that attracts many fund managers to Jersey is the fact that our limited partnerships law is broad, it's investor friendly, and it's also been made more GP friendly here. In this particular case, our limited partnerships law has recently been expanded or improved to allow for expanded safe harbors activities for limited partners. So these are the activities that limited partners can participate before, without actually limiting without threatening their limited liability status. So that includes additional voting requirements or additional participation with the GP, but still being safe so it doesn't affect their limited liability. We've had additional limitations to restrict LP access rights in relation to records. I think that's been needed, much needed for the last few years. And also one of the things that a common feature is for committees to be established in relation to a fund. And there've been some expanded powers there and also some additional clarifications that committee members there, for example, who participate, so these are limited partners that are participate on that committee, there is no fiduciary duty owed to each other. And also there has also been the introduction of third-party enforceability. One of the other recent advents introduced in Jersey just this year is the limited liability company. Now, this is an LLC that will be familiar to many of those, for example, in North America. It combines limited liability structure with tax transparency, and it should be very familiar to those having formed LLC, say in North America, because it's very similar in terms of requiring an LLC agreement with its members. It has unlimited capacity, and also members of an LLC may be a manager or otherwise may be in charge of the direction of the LLC. So that is, we're hoping that will gain some traction over the next few years and add to the armory that Jersey has in terms of its fund offering. Fran, over through to you on Guernsey.
Thanks. So some developments from Guernsey. Guernsey's completed overhauling all of its regulatory laws in what was known as the Revision of Laws project. It effectively means that it's updated its supervisory and enforcement laws in line with global standards without seeking to introduce any unnecessary policy changes. I also wanted to say a word about sustainable finance, which Guernsey as a jurisdiction has made a strategic commitment to. Key to this is seen as having enabling on-island environment, and some of the initiatives which have been introduced include the Guernsey Green Fund, which is a designation for Guernsey funds that meet strict eligibility criteria of green investing and which have the objective of a net positive outcome on the environment. And there are approximately 5 billion of net asset value in Guernsey Green Funds. The natural capital fund regime has very recently been introduced with the intention of channeling investment into biodiversity and natural capital, and which has a broader nature-focused scope than the Green Fund. There's also been an introduction of anti-greenwashing guidance for the investment sector to ensure that there are adequate disclosures are made to investors in respect of environmental sustainability claims. And all of this is designed to give confidence to investors who want to invest into sustainable finance through a Guernsey fund. Finally, in terms of legislative horizon scanning, Guernsey, like Jersey, recognising the significant interest of US managers in the jurisdictions and wanting to encourage this, we're currently drafting legislation to introduce LLCs, and that legislation is expected to be published later this year. And this follows hot on the heels of legislation enabling migrations, continuations of limited partnerships into the Channel Islands. So that's it from Joel and myself, and I'm now going to pass over to Mike and Sally.
Thanks, Fran. Thanks, Joel. Can I just get a thumbs up from a fellow speaker if you can hear me okay, please? Excellent, lots of thumbs raised. I've also had IT dramas. Afternoon, everyone. We've heard a lot today about the opportunities, I suppose, for private capital and the regulatory regimes in Jersey and Guernsey. Let's talk now about one of the risks and how to mitigate that risk effectively. So regulatory risk is prevalent for all entities in the private capital space, and it's a risk that's changing continually. You can't eliminate it, but by staying on top of it, you can have sufficient controls in place to give reassurance to the regulator that you're managing that risk appropriately. And one way to do that is to stay on top of the regulatory agenda and be prepared. Now, the global environment for regulation is bringing many headwinds for firms, with changes coming through almost daily from bodies like OECD, IOSCO, the EU, and the FATF. And that's before you get to what the domestic regulators are up to. So I wanted to briefly cover the regulatory environment offshore, and particularly how the FATF is shaping the regulatory agenda here, given what most of the international finance centres are going through, which is a cycle of jurisdictional assessment. So I'll be speaking mainly from a Channel Islands perspective, but you can certainly extrapolate out everything that I'm saying to any offshore centre, and indeed most onshore centres these days, because all jurisdictions are responding to the same international dynamic. So let's start with some context about the regulatory landscape that I'm sure, or I'm hopeful many of you are already aware of, but it's worth repeating and explaining in a little detail, as it will help you understand the regulator's drivers at this time and why supervisors are behaving as they are. and it will put you in a better place to understand the regulator's approach and perhaps deal with their examinations. So we start off with the international anti-money laundering standards and the assessments of jurisdiction. So those pesky people at the FATF that are causing us all, regulators and the regulated, to focus on anti-money laundering. If you only remember one thing from my presentation today, it's just that second bullet there, evidencing effectiveness. This for me is the key overarching theme for the next few years. The regulator is going to have to do it themselves, and it will expect the same from firms. So what do I mean by this? It's really moving from technical compliance to being able to evidence that the work you're doing in any particular area is having a positive impact on outcomes. Quite simply, what you are doing is effective. So I'll give you a couple of examples, hopefully it will explain it. For the regulator, when I worked at the regulator and we were assessed internationally, we used to be able to say, look at our regulatory regime, look at our laws, our subordinate legislation, our codes, they're equivalent to the international standards, so we pass the test, right? Unfortunately, things have moved on, and they've moved on quite substantially. That the former is a given now, that sort of architecture of technical compliance. But the regulator now needs to back that up with evidence that the regime itself is effective. So for the regulator, it's how many visits have you undertaken? What is your risk system? How does that let you select who you visit in a data and fact-based way? What are the outcomes from those visits? How many prosecutions does your jurisdiction have on firms and individuals from a criminal or regulatory angle? And how has firm behaviour improved as a result of your supervisory activity? And the regulator needs to evidence that, which is quite difficult. So we're seeing from the JFSC and the GFSC more control testing of entity remediation. So following supervisory activity, perhaps even enforcement activity, and a period of remediation with a firm, that the firm then has to evidence that they have remediated effectively. And this is part of the course globally in terms of regulation. So that's what a regulator has to do these days, and they expect the same from firms too. So gone are the days when you simply had to have a compliance officer, a procedures manual, a business risk assessment. That's a given, that's technical compliance again. These days, it's, for example, if you take the business risk assessment, it's much more about how did you produce that business risk assessment? When and why did you last review it? You know, show me the board debate in relation to it. Have you had any independent assurance or testing of it? Have you mitigated risk differently as a result of the most recent update? Perhaps have your service lines altered? Has your client take on procedures changed? Have you increased resources in X and reduced resources in Y as a result of your most recent update? So it's really taking things to another level in terms of their expectations, and it's here to stay. And I don't think good firms have anything to fear from this approach at all, as most firms will be doing this anyway for very sound business reasons. But even the very best firms aren't always evidencing it. So that's one of the top tips, is to make sure you've got that audit trail. If you can't point to a document that shows you that you've done it, then you haven't done it, quite frankly. So that's what I mean by evidencing effectiveness. And it's something that we're going to hear a lot more about from all regulators, onshore and offshore. And the reason why Jersey and Guernsey is turning its attention to AML particularly is both jurisdictions will be assessed by Moneyval in the next year or so. So Moneyval is the European agency of the FATF, and it's driving almost all activity and behaviour from regulators and government at the moment. So we're seeing an increase in supervisory activity, a bit of an increase in enforcement activity in the financial crime space, jumps in the number of penalties for firms and individuals, as the jurisdictions will be looking to evidence that to the assessment team that comes along. Now, if you're thinking, oh God, this all sounds a bit horrible, there is no alternative, and I think, you know, there is. So I'm not quite saying there's nowhere to run, but this is how regulators operate globally these days. And if you look at Jersey and Guernsey, they have been watching the rest of the world's assessment, and they've seen the practical consequences recently with Cayman, with Malta, with Gibraltar, UAE, and others, you know, of a bad assessment and perhaps bad ongoing management of that FATF assessment process. So that's why the jurisdictions are investing in this regulatory government activity. You know, avoiding an FATF grey listing is obviously paramount, because there are implications there. So jurisdictions would no longer be able to place reliance on regulation in that jurisdiction. You need to do enhanced CDD for investors. There could be EU blacklistings. There could be reputational impact and cost. So that's why it's driving regulatory and government activity. And you can see what it's going to be. You know, there's no hidden agenda here. It's all published. Jersey and Guernsey have got their national risk assessment documents. There's lots of consultations out from both regulators and government at the moment in terms of the changes to the regimes. In Jersey, we're seeing changes to the money laundering order, civil and criminal operating procedures. I mentioned increased sanctions activity as against firms. Much greater data gathering as well. That's an increasing regulatory trend and one that your firms can manage effectively. And we're also seeing more and perhaps more detailed public statements against firms and individuals with an AML or countering the financing of terrorism focus. But I've got a couple on the slide just to very briefly point out. One is the exemptions review. So when jurisdictions get assessed, they have to be able to explain the quantum of firms enjoying any regulatory exemptions, and Fran and Joel have just talked you through the regimes there. The regulator needs to explain whether they're risk-based, and the regulator also needs to have underlying data behind them. And jurisdictions typically have struggled to meet this requirement, so that's why Jersey and Guernsey have been focusing on their exempt activities regimes, and there are some changes working their way through the system at the moment. It's primarily AML based, and there is actually a consultation in Jersey that's live as we speak. And the second one is a bit more broad regulatory perimeter. So this is linked to exemptions, and this is bringing in new regulatory activity. So less relevant to the private capital space, but things like family offices being regulated, pension regulation, virtual asset service provider regulation. Conscious of time, very briefly, wanted to mention principal and key person focus. I'm sure some people on the call today will be board members, will be principal persons, maybe key persons as well. And we're seeing more of an onshore type focus from the Channel Islands regulators, perhaps more akin to the UK senior managers regime. So many more interviews of prospective key and principal persons. There's nothing to fear there. They're just checking that you understand the role that you're taking on and that you're aware of the risks with the business. They also do exit interviews as well of people leaving firms. Supervision priorities, the JFSC publishes their themes regularly, and the 3 themes at the moment that they're looking at won't surprise you given everything else I've said. It's anti-money laundering, business risk assessment and strategy, the role of the money laundering compliance officer, and also beneficial ownership and control. And again, this just shows you an increased supervisory activity where there needs to be. And then finally from me, and very briefly given time, cyber, all I would say here really is it's no longer something you can just leave to your IT department. The board, compliance, risk, legal, senior management all need to be on top of this. It's going to be an upcoming area of focus for the JFSC and the GFSC. Both have rules and guidance in this space now, so both will be looking to test firms' compliance with those rules and guidance. So you'll probably see things like cyber-themed examinations coming out from the regulators. That's probably my time up, so thank you all for listening. I'm now going to hand it over to my colleague, Sally, who's going to explain how we're guiding asset managers in light of this challenging regulatory agenda. Sally, over to you.
Thank you very much. I didn't want to just tell you the areas which prove challenging for all businesses, but to give you a few ideas of what you should be focusing on in each of these areas. We provide a lot of application support for new regulatory license applications, along, of course, with our legal experts. And really what we're helping to guide you on there is ensuring swift turnaround time for those applications. What is it that the regulator wants to see in that application that's going to satisfy them? They've got the right people controlling the business, that the risks are going to be well managed. Looking at the business plans, which of course support the applications, what should be addressed in this plan is something that we're talking to a lot of clients about, where plans are non-standard or the business model is slightly non-standard, what risk and mitigation should be considered there. And then moving on to when the business is operational, when the license is held, business risk assessments. This will always be an area of focus for all regulators because it's the one document that really gives them a good flavour of what it is that your business is doing, how you understand the risks that your business takes in its day-to-day operations, and quite well how well those are documented in your policies and procedures and how well they effectively operate. Now, the big thing to business risk assessments is having data points to constantly refresh and update that risk assessment to show, as Mike said, that you're demonstrating that it's an effective tool for managing risk. Board effectiveness reviews are an incredibly useful tool. Those can be undertaken internally by your third line of defence. They can be undertaken by an independent party, but they need to be done to demonstrate that the board is operating effectively, back to that effective theme. Framework AML compliance function reviews. A lot of this comes back to effectiveness of controls and resourcing, particularly. Resourcing, as we all know, is an industry-wide challenge in most areas, but not least in the world of risk, compliance and financial crime. The regulator understands that position, but it doesn't make any difference to how they expect you to resource your functions so that those controls are operating effectively and you've got appropriate advice. So getting some third party or independent assurance on whether those functions are adequately resourced and fit for purpose is a good thing to consider. Supervisory examinations, both regulators in Jersey and Guernsey are increasing the number of examinations they're undertaking, making better use of the thematic approach for coverage across different sectors of our financial services industries. I think this is a good thing. The feedback that come back from those supervisory examinations are a really valuable tool for all regulated businesses and should be considered. But in terms of the support we're providing to regulated businesses, it's preparing staff, employees and non-executives in advance of those examinations, and then having a high-level review of key policies and procedures and governance documents to make sure that the key elements of what the regulator will expect to see are there in place in your business. And the less enjoyable end of the spectrum, enforcement and remediation, where we hope that our clients and industry won't find themselves, because we like to think it's a very well run jurisdiction, but it does happen. And when those findings land, it's important to understand the severity of the risk presented by the findings that are being reported by the regulator, and responding to those with a really good understanding of the root causes behind those findings and how you as a business are going to address them. So these are all areas where we've seen a lot of activity from the regulatory side, but also activity from an industry side. Obviously, there's a correlation. And I think on that note, I will wrap up and pass you over for any questions. Thank you.
Thanks very much, Sally. Thanks all. Well done for getting us back on time. We did have one question which was sent through actually before we even started, so which gave us the opportunity to have a quick look at that, which was an interesting one, maybe a difficult one for us as folks operating out of the Channel Islands to respond to. But the question was, could we comment on the landscape in Asia Pacific vis-a-vis the rest of the world? Is this a time for increased focus on APAC, Asia Pacific region, or a cautious approach? Very interesting question. I mean, I think one thing to say is that if you look at the historic growth of the APAC asset management industry, it's been pretty meteoric. I mean, in the last decade, assets under management have grown at sort of 2.4, I think, times the rate of the US, which itself has been growing and growing and growing, and 3 times faster than the EU in that period. So clearly, asset management as a discipline and private capital investment is absolutely flourishing in that region, and there's little to suggest that that's going to dramatically stop in terms of its relative growth trajectory relative to other parts of the globe. And of course, it's a very diverse market. You've got China, Hong Kong, Japan, Taiwan, Indonesia, Australia, New Zealand. So I think there's a lot to be reasonably confident about, but I don't think the APAC region at the moment is separated from some of the economic turbulence and market turbulence that we described earlier in the context of the EU and US markets. You've got the nascent signs, I think, of a recession as per the EU and the US. Like the US and European markets, a bit of a depressed IPO market, which will create exactly the same type of exit issues that Darren and I described. And actually, very interesting, Asia just seems to be following global trends, an increase in the secondaries market in the Asia region, no doubt about that. And every region has its own geopolitical tensions, and at the moment, there's quite a complicated regulatory disclosure matrix, which I think is being applied to deals in the region, largely because of the sort of tensions which have arisen, particularly as between China and the US. So cross-border activity between China and the US, I think, has been a bit disrupted. signs of delistings of Chinese companies in the US because of some of those regulatory disclosure concerns. And you know, China itself, from having a full bore policy of chasing high growth in the last decade, is probably moving more towards a sort of sustainable development bias, and that's probably impacting on a few industries. So actually, I think the picture in the APAC region is probably very similar to what we're seeing in the US and the EMEA markets, just different disruptive events. But I think our view, certainly the view of our partners out in our Hong Kong office, and I'd recommend people read a recent article, excellent article by Paul Christopher, who heads our team out there. You know, we think private capital will hold strong, and that the strong growth rates that you've seen in the APAC region will probably outshine those that you've seen in the US and the EU for years to come. So hopefully that gives you a little bit of thought on that question. I'm not sure we have any others, but please, anyone that's been listening in today, if you have any thoughts or questions, please send them through to us. Just like to thank the guys at Mondak for setting this up, getting us through our IT foibles at the start, and a huge thank you to Francis, Darren, Sally, Joel and Mike for their contributions. Thank you all very much for attending, and hopefully we'll see you again at another one of these sessions soon. Thank you.
Thank you.